So illustration 13 on which our friend has got a doubt. An entity has taken a loan facility from a bank that is to be repaid within a period of 9 months from the end of the reporting period. Prior to the end of the reporting period, the entity and the bank enter into an arrangement whereby the existing outstanding loan will unconditionally roll into new facility which expires after a period of 5 years. How should such loan be classified in the balance sheet of the entity? Will the answer be different if the new facilities is agreed upon after the end of the reporting period? Will the answer to A be different if the facility is from one bank and the new facility is from another bank? Will the answer to A be different if the new facility is not tied up with the existing bank, but the entity has the potential to refinance the obligation? Yes. One moment. So now, let us just go through the question once again. An entity has taken a loan facility from a bank that is to be repaid within 9 months from the end of the reporting period. So we have a bank loan facility which has got to be paid within 12 months. That is on the reporting date. Prior to the end of the reporting period, the entity and the bank enter into an arrangement. That means there were some negotiations carried out prior to the end of the accounting period, whereby the existing loan, outstanding loan will unconditionally roll into new facility which expires after a period of 5 years. That means this 9 months end repayable amount will be extended for a period of 5 years, right? So prior to the end of the reporting period, the entity and the bank enter into an arrangement whereby the existing outstanding loan will unconditionally, there is no condition that they got to do, will roll into a new facility which expires after a period of 5 years. That means there is no condition that they got to satisfy anything to have this facility where the repayment period is likely to get extended 5 years. It is not yet finalized. It is only in the negotiation stage. Arrangement, it is not yet over. Am I right? Enter into an arrangement whereby will unconditionally, okay. How should such loan be classified in the balance sheet of the entity? How it should be extended, current liability or non-current liability, right? So, and say I would like others to participate. Vanessa and Pavan, could you tell me as what exactly is the requirement that you have? Okay, other question, will the answer be different if the new facility is agreed upon after the end of the reporting period? So first one, they have negotiated and finalized even before the end of the reporting period. So that means by 31st of March, say 2023, whether it is a current liability or non-current liability. That is the first question. Second question, will the answer be different if the new facility is agreed upon after the end of the reporting period? So by 31st of March, it was 9 months outstanding. After the year end, but before finalizing, they have come to a conclusion that this period of repayment is extended beyond 9 months, that is 5 years later. So the first one had happened before the reporting date. Second one, this particular case is taken to events occurring after reporting period. Then will the answer to A be different if the existing facility is from one bank and the new facility is from another bank? So the third part of the question is that it is not the same bank, where for the old facility, you got to repay it by 9th month only. and the new facility is running from the new bank. So how is that C part will be different from that of the A? Then next D. Will the answer to A be different if the new facility is not tied up with the existing bank, but the entity has the potential to refinance the obligation? Correct. Yes. Vanessa and Pawan, can you throw more light on onto the subject matter?
Sir, if it can be settled within 1 to 2 days
So are you answering for the first
from
part
the
of the
end of the
question?
reporting period, it can be classified as. Yes, sir.
First one, with the same bank where they have already negotiated by 31st of March, is it current liability or non-current liability?
Non-current liability.
First one is the non-current liability. Second one,
Current liability.
current liability. Why current liability for the second one? So will you not consider this as events occurring after balance sheet date and take this matter as if it was done on or before the reporting date and be taken up as non-current liability? Why is that B is different from that of A? Ind AS 10 communicates that we are expected to take into consideration such items as adjusting event, and adjusting event does not mean it should be debiting or crediting some account with the same balance. It impacts only the classification part and not in any debit or credit of asset or liability. So it is only a classification change. Why not you take it up B as part of your current liability only if it were to be events occurring after balance sheet date? Then C. So when you are doing it for one bank and for the another bank, yes, Venkatraj has got some suggestion. Can you just speak out because others need to. So from here.
The first one, okay, non-current I'm able to understand because 31st March, Aniket, we know that it's repayable only after 5 years. But the second one, 31st March, as on date, we didn't know anything, but suddenly they changed it after 31st March. That new facilities agreed on after, but still, why is that we are giving current because of the events occurring after reporting period? That I
First one for which there is no problem at all. It is there is non-current liability only. There is no. Second one, events occurring after balance sheet date impact. Ind AS 10 is invoked and therefore it will continue to be non-current liability, and we will consider as if the negotiation done after reporting date as arrangement was done before maturity date. Are you understanding that? Right. So as far as C is concerned, so the existing facility is from one bank and the new facility is from another bank. What would you do for the first one and for the second one? See, for the old bank, still your repayment is standing at same 9 months period. So therefore that being current liability. So for the new facility that you are taking from the other bank, it will be taken up as long term. Now let us just see that. The loan is not due for payment at the end of the reporting period. The entity and the bank has agreed for the said rollover at the end of the reporting date for a period of 5 years. Since the entity has an unconditional right to defer the settlement of their liability at least 12 months after the reporting date, their loan will be classified as non-current liability. Correct? This is what we have just discussed. Next one. Yes, the answer will be different if the arrangement for rollover is agreed upon the end of the reporting period, since assessment is required to be made based on the terms of existing loan facility. As at the end of the reporting period, the entity does not have an unconditional right to defer of the liability at least 12 months after the reporting date. Hence, the loan is classified as current, which is wrong. Which is wrong. This is what I was just telling you. Please understand, will the answer be different if the new facility is agreed upon after the reporting, end of the reporting period? So if you invoke Ind AS 10, the answer is wrong. What answer that you provided is wrong. I will prove. I will prove that. See, there is institute had just given wrong answer in this particular case. I will give you exactly opposite is what they have just given. I will give you the example. I'll give you the case with Ind AS 10 only. I just need to check. See, can you just read this? Example 8. Vanessa, can you just read? Or I will read. Please just. ABC Limited, in order to raise funds, has
Okay.
privately placed debentures of 1 crore on 1st January, issued to PQR as per the original terms. The debentures are to be redeemed by 31st of March X9. One of the conditions of the private placement of the debenture was that debt equity ratio at the end of any reporting period should not exceed 2:1. If this condition is not fulfilled, then PQR has a right to demand immediate redemption of the debentures. On 31st of March X6, debt equity ratio exceeded 2:1. Therefore, PQR decides to return the debentures. Thus, by 31st of March, the liability of ABC towards PQR, which was originally long-term liability, becomes a current liability, since it is now a liability on demand. However, ABC enters into an agreement with PQR on 5th of April X6 that PQR will not demand the payment immediately. The financial statements were approved by Board of Directors on 30th of April. In this case, the agreement of PQR will not demand the money immediately is a subsequent event. Even though it is subsequent event not affecting the condition on the balance sheet date, yet because of the specific provisions of para 3 of Ind AS 10, it has to be given effect in the financial statement for the year 5-6. Accordingly, though as per the original terms, the liability would have been otherwise reclassified as current liability as on 31st of March X6, by giving effect to the event after reporting date to be specific provisions of para 3 of Ind AS 10, it would continue to be reclassified as non-current liability on 31st of March X6. In other words, reclassification of debentures as current liability as at 31st of March X6 will be adjusted, and once again it will be classified as non-current liability as at that date. Are you understanding this? What is that they are telling? So the demand payment of the demand within 9 months period, when it is negotiated, even after the reporting date, we are expected to give effect for that and consider this as if it was done before the reporting date. So therefore, the answer what they are given in Ind AS 1 and Ind AS 10 are not consistent. Are you understanding what I am telling? Yes or no? Vanessa, are you understanding what I am telling?
Yes, sir. Yes.
So this is a place where if I say it is wrong, institute is wrong, people will not believe me. They will believe what the institute is saying is right. But it is a similar scenario what you have seen there. But they have to be very careful. This is not correct. Yeah.
Sir,
Yeah.
sir,
Tell.
so for exam, should we write both answers from both
No,
points?
I will put it like this way. How you write the examination without affecting our prospects. You put this case this way. Renegotiation is carried out. One, before board of directors approval. The other one, after board of directors approval. If it is before the board of directors approval, it is events occurring after balance sheet date. That is after reporting date, after reporting period. Not events occurring after reporting period. Adjusting event, not applicable at all. If it is an adjusting event, so we have to put it out as non-current liability. So here it will continue to be there as current liability. Because in this problem, they have not given by what point of time the board of directors have approved. Pawan, are you there? Pawan, I think you are just gone for having some snacks. Is not there. So this is the way you communicate the answer. Are you clear? Now, third part of the question. If it were to be from the new bank, the loan facility arranged with the new bank cannot be treated as refinancing, as the loan with the earlier bank would have to be settled, which may coincide with the loan facility arranged with the new bank. In this case, loan has to be repaid within 9 months from the end of the reporting period. Therefore, it will continue to be there as a current liability. Correct? That is the conclusion that we have just made. Because I have not repaid with the old bank. And the new bank facility will come only when they finance the old bank, and therefore there is no outstanding with respect to the new bank. So it is all about the outstanding as they have discussed. So there is only one current liability. The new bank negotiation, that liability we will assume only when the old liability is settled. So by reporting date, there is no problem at all. Are you understanding? Shall I close Ind AS 10? Say in Ind AS 10, it is example number 8. So in this particular thing, no, this had become carve in, carve out with IFRS. Why I could just there is recall very fast is that the same subject matter, if it were to be done under IFRS, in IFRS they say this sort of renegotiation done after the reporting date and all that, they have said it is not adjusting event at all. They have not put this under adjusting event, whereas under Ind AS 10 it is taken up as adjusting event. That is the reason as why I remember it. Anyway, that's a nice example for comparison. Have you understood what exactly is the mistake they have committed, Vanessa?
Yes, sir. Yes.
Right. Yes. Last part, will the answer to A be different if the new facility is not tied with the existing bank, but the entity has the potential to refinance the obligation? Say, when they have the potential to refinance, then the answer is going to be continuing to be the same current. Now, let us just see how. Yes, the answer will be different. The loan should be classified as current only. This is because as per para 73 of Ind AS 1, when refinancing or rolling over obligation is not at the discretion of the entity. For example, there is no arrangement or a refinancing. The entity does not consider the potential to refinance and classify the obligation as current. Look into the question once again. Will the answer to A be different if the new facility is not tied with the existing bank? That means I continue to have the repayment carried out 9 months later, but the entity has the potential to refinance the obligation. Refinancing is an independent operation, but my existing obligation will continue to be there, and your refinancing potential will not change the classification of liability, and that will continue to be there as at current. Is that clear? Okay, now let us just consolidate. First one, if loan is negotiated, redone before balance sheet date, it is non-current. In this particular case, I told you by invoking Ind AS 10 and as well as assuming that board of directors approval was done later, as far as books of accounts approval is concerned, we will take it up as non-current. Next one, that will continue to be as current only. Last one will continue to be there as current. So current, third one current, last one also current. The second portion where it could be current liability as well as non-current liability, depending upon at what point of time the approval is carried out. Is that okay? So with that, you just completed the doubt clearing session. And let me just find out, Venkatraj, is that over as far as your doubt is concerned? Vanessa, do you have any doubt?
Sir, as of now, no.
Right. Okay, you can just raise. Every Sunday we used to meet between 4 to 5. Okay, thank you.
Thank you, sir.
Thank you.